All right. Good morning, everybody. All right. Got a little bit of a currency war going on, and the Fed is going to be all over the news today. Got a lot of speakers um, around the world. So as you can see, it's a full house. We got speakers probably about every 30 minutes. Bostic is going to be back on TV again today. He was actually on TV last night, trying to calm things down a little bit. Yellen popped in on, I believe it was Friday. Didn't really do any good. I know there's a double bottom in the market right now, and everybody thinks that this is a great time to go long. And you're right, from a risk to reward standpoint, this is a really good time to go long. It's a time where you could risk the least. Whether or not it plays out, looking at everything that's going on, of course, you want to, take advantage of it as close to the bottom as you can so that you can use the smallest stop possible, not necessarily in the ES, but across the board. There's just a whole lot out there that suggests we're not going to bounce for more than a 2-day rally, maybe 1 or 2-day rally before we continue to roll over and go lower. On deck today, 8:30, 10:30, we have manufacturing, and then we have additional auctions 11:30 and 1 o'clock. Those, they really don't get the attention that I feel that they deserve. I always pay particular attention on the days where we have these additional auctions. They mean a lot to my evaluation of how the trading day is going and if we're going to see any sort of midday reversal, V bottoms, rounded reversals, things like that, or if it's going to get worse, right? If we've been moving in a particular direction, we pause for lunch like we normally would, and then we start to take off when these auctions come through. The volume is not overly extreme. We're sitting in the 200s. We were in the 200s on Friday and on Thursday, so we're not really out of line for this point of time in the morning. A little high compared to what we've seen in the last few weeks, but still nothing overly extreme. And that's all that we need that indicator for, so we could turn it off. We ran up and tagged the daily pivot, so that's no longer an MDP. We also closed the gap again. When we opened, gapped down, first thing we did is ran up and closed that gap. In case there was any doubts, the market did it again during the kill zone. We've now crisscrossed through that open enough times, it probably doesn't have any validity left to it. We've got an ADR right now of 2.5. It's about a $91 expected move. Half of that to the upside would be 37.50. Then we'd have the weekly pivot point at 37.70. Yesterday's high at 37.83 and a full ADR at 37.97. If we continue to be weak, we're going to be looking for an inside day breakout to the downside. That's not only yesterday's low, it's the previous week low. So if we break below 36.59.5, we are in an inside day breakout and an inside week breakout. Below that, we've got an ADR full at 36.13. The base case argument is for us to hold these lows. So let's talk about that for a moment. We're in a new week, right? Thanks, Captain Obvious. On Friday, we had a slight expansion that was about as big as the entire expected move of last week, right? In one day. Now we're inside of that day. And unless we leave that to the downside, we're likely to be inside of that day for a few days. Now, one thing that's pretty cool about having a big day, whether it's a big green one or a big red one, is that you can actually measure the entire candle and then use that. You can plot against it to the upside or the downside, but you can also plot a 50% measure. The thing about having a very fast, very hard sell-off, and then coming in the next day is seeing a market retrace it by about 50%. So for an example here, this big day, now that I'm zoomed in, that doesn't look like a very big day, but if I was zoomed out, it would be a pretty big day. The next day we opened and we ran up and got about 50% of that candle. And that's all she wrote. What do we have this morning? A market trying to rally up to 50% of that candle. It might have already got it. It's not to the tick perfect. That same little tactic or trick or analysis can be done on any time frame, by the way. And a lot of traders will do that on a weekly. So if we think about, the scope and the pace and the size of last week's candle, well, there's your 50% mark. 37.98. There is a little bit of talk about a 1 or 2 day rally, a little bit of a rally like we seen on that day after selling off 3 days in a row, had a little 1 day rally before continuing to the downside. We're sitting here along these lows. If we're going to get a 1 or 2 day rally, this would be the time to do it. So kind of want to ask that question, are we due for a bounce? Have we moved far enough? And this indicator says, yeah, we've moved far enough. We are due for some sort of pause or reversal or flip, and it doesn't have to last for very long. We're just talking about getting closer to the 10-week moving average. We're kind of getting a little too far away from the 10-week. And that implies that we are going to pause or consolidate or turn around and go back the other way. Even just for a day or two would kind of get this indicator closer to maybe a 4 or a 3, right? It wouldn't take much. So this is the 10-week in distance from the 10. You can see we have gotten farther away from the 10 than we are right now. Back in the when we hit the lows on the year in June, we actually had expanded nearly 9% away from the 10-period weekly moving average. Right now, we're sitting at around 6%. So it's not the most extreme we've seen this year, but it's getting there. So let's flip that over and turn it to a day. And this says the same thing. It's not the most extreme. We've been farther away from the 10-day than we are right now, but we're certainly near that spot where it tends to be more than enough. So, answering that question, have we fallen too far, too fast? And are we ready for a little bit of a relief bounce? This says that it's absolutely possible. I don't want to say probable, because with everything that we saw going on yesterday, or I should say last night, yeah, the plunge protection team is active right now. So, we'll see how good they can do. All right, 10-day, 30-minute volume profile. The thing is massive. It basically is from the top of the chart to the bottom of the chart, and that's not very helpful at all. From our current location, we do have a significant level of volume at 3,700 to get through. If we can get through it, we've got clear sailing to about 3,780-ish, but it drops off before 3,800. So, as much as we like to believe that roundies are areas of psychological support and resistance, blah, 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 this says not so much, right? That 3,800 isn't going to have a lot of resistance compared to the 3,700. Now, that doesn't mean it won't get defended. Should we run up there, you'd want to watch the dome and see if who's participating out there. But looking at old volume, there isn't as much at that roundy as there is at 3,770, 3,780. So resistance at 3,700, 3,770. And if we actually manage to get there, the point of control is at 3,875. I mean, it's doable, but the plunge protection team would have to put it into overdrive for us to get that far up there, right? When it comes to volume by time, it's not as much. It's a lot lower than I would have expected it to be. I'll leave it be. All right, we still have an untouched point of control at the June low. That's Thursday's point of control. I don't know, an argument could be made that we hit it. I think we did make that argument, right? Yeah. So the nearest untouched point of control would be all the way up around that 3890 area. Now you could carry forward the value area high and the value area low from yesterday. I generally don't do that, usually because I'm already marking things like the open, high, low, close. And for an example, the value area low of yesterday is the low of yesterday. So I already would have been carrying it forward. For the value area high, well, it's really close to the Globex open, to the high of the previous day, and to that June close. So I've already got enough pivots up there. I don't need that one. That doesn't mean that you couldn't. I've just never really seen a lot of value in it. Let's talk extreme for a minute. Should things get crazy again, right? Say the plunge protection team fails to do their job, or fails to accomplish their task. 35.65, 35.70 is well within reach. That would not even be considered extreme at that point. It's less than a 4% move. We wouldn't even trigger any of the halts and locks. So if things really start to get nasty, keep your eye out for a market maker move. If there is such a thing, it will start showing up right in here. So one thing that I completely disagree with Thinkorswim about, if there's no market maker move, there's no signal at all. And if there is a market maker move, then there will be a signal. That's not very helpful for people that are new to this and think they need to turn something on, or that they're in some way are doing something wrong, and that's why they don't see the market maker move. When in fact, it's just, if there isn't one, you won't see one. Here, for an example, in Tesla, you can see how the market maker move is suddenly there. There is a market maker move in Tesla this morning, and there's the tag. Right? So if there's no tag, keep your eye on seeing a tag pop up using this label that I use. If a market maker move was to pop up, it'll show up in the label. That's easy enough. Now, I've been talking about the downside, but what if we were to get extreme to the upside? Well, we can just do the same thing that we did before. Copy the distance between these two lines. It doesn't have to be perfect. You don't have to nerd out with the calculator. Just kind of ballpark it a little bit. Once you've got that line, set it up to the next level. 38.47, 38.50-ish. And that wouldn't even be considered extreme, right? That would just be kind of maximizing the edges. Now, the likelihood of us going anywhere in my opinion is less than us basing here today, mainly because we don't really have any economic material on deck that is sufficiently big enough to get us out of our current slump, right? And with the Fed out talking, everybody's going to be trying to calm this market down, try to get us to hold the lows. If we start to see some kind of short covering rally, we could get this kind of rip your face off 6% rip to the upside. It's there. I don't believe it, but you know, it's on the table. And if everybody says screw the Fed, then they can just dump this thing, and that's there, but I don't believe it. Right? I think the base case argument is that we hold the line today between Friday's high and Friday's low. That should be your benchmark for anything, right? You want to go lower, let it break outside of yesterday's low. You can go higher, same thing. Now, since we're near the lows of the range, waiting for it to break through the high of yesterday would be waiting for the ES to get all the way up to 37.83. Well, screw that. I'm not going to sit out and watch that thing run 100 points waiting for it to get out of that level, right? But you could at least start with, say, our own Globex range, 37.18. Or say getting in on the lows and then running it up to that level. You got the daily pivot, the weekly pivot, and 2 ADRs, not including the cash open of yesterday and the Globex low of the previous day. So a lot of pivot points to play against. I heard there is a hurricane headed for the Gulf. That very likely is going to cause a move in energy, likely to the upside. We're going to be looking for Japan to defend that 145 again. They've made it very clear that they are not going to tolerate the US dollar Japan getting above 145. And well, it's on deck. So, you know, when it comes to the dollar just absolutely ripping, and you know, we can see the effects of that between dollar Canada, dollar China, dollar Japan. And we can see the inverse of that with euro dollar and GBP dollar. They have a nickname for most of these, but I don't know the nicknames yet. Except for the loonie. I remember the loonie already. That's an easy one to remember. That's US Canada. And as with most nicknames, you got to kind of know the why behind it. I don't know the why behind it. I don't care. There is a symbol for the energy that we would want to focus on if we do get that hurricane in the Gulf. Let's see. Nope, that ain't it. Yeah, GNRC. If we get a hurricane into the Gulf, we're very likely to see this name get a bit of a rally. Now, remember, it's not going to stick, right? It's not like we're going to swing trade this thing over, you know, the course of the next 2 months. It would just be, hey, we're likely to see a significant short-term rally. Got a lot of activity in the short interest names this morning. And when I was going through some of the news here on Thinkorswim, kind of the pre-market, what's moving stuff. Casinos, Las Vegas Sands, MGM Resorts, Wynn Resorts, and Melco Resorts rose in pre-market activity Monday after Macau's chief executive said China would resume the issuance of electronic visas and allow group tours for mainland travelers. So that gave a lot of those casino names a bump. And then a company called PaySafe tied in with Caesars Entertainment and DraftKings. PaySafe is going to be the payment company that's going to deal with like people's debit cards, credit cards, things like that. And they just moved into Kansas, according to the news. That didn't really help McDonald's out any. Yeah, Las Vegas Sands made about 7% in the pre-market, and Wynn Resorts got about 5%. Melco Resorts made nearly a 10% move in the pre-market. So, it's not going to stick, but if that's the hot stuff in the pre-market this morning, then yeah, why not, right? So the short covering rally that we were looking at on KWeb seems to be connected directly to China names, because if you go in looking at the Reddit board short interest names, they're junk this morning. AMC, ABBY or BBBY. So most of the Wall Street bets names are down ahead of them open this morning. So we're not going to be looking in that direction yet. With this short covering rally, it often can bleed over into other things anyways, right? So it might start with the China names in KWeb and then bleed over into like the Reddit crowd Wall Street bets, which could then bleed over into one of those crazy rip-roaring rally days. But remember, we're just looking for a 1 or 2 day bounce before everything rolls over and continues that move to the downside. We could see some defense. It's true. I don't necessarily believe it. There's this great picture that is updated every day on Twitter by a number of sources. So, I mean, you can get this certainly from a lot of different places. The year 2022 is this white line, and the year 2008 is this yellow line. And as you can see, it's not spot on perfect, but we have based around the same time as we did in 2008. We've broken new legs and gone lower like we did in 2008. We even had rallies with head and shoulders like we did in 2008. And right now, we're just about to enter into the oh damn, it's about to get nasty phase, right? Just like we did in 2008. It's not spot on perfect twitch for twitch all the way down, but so far every base has based, every rally has rallied, and every double bottom that broke has broke. All right, so you might be able to see, if I get close enough here, that there's a little bit of a rally in 2008 because it made a leg down and then it bounced up a little bit before it rolled over and it continued to move to the downside. Right, that's 2008 right there. In white, which is us right now, we also made that move down, bounced, came down. Well, we're there. We're right there at that spot. We could get that 1 or 2 day rally, a little bit of a move up, but you see what's coming. Now, back here, it went lower, but it went lower compared to its own price, right? And we went lower compared to our own price. Does it make sense? Right? So, you can, like I said, you can get this from a couple of different places. Heck, you can go and do it yourself. You can overlay charts on Thinkorswim, and this is not new information. Just pointing out that we're on schedule, right where we should be, and well, you can see what's coming. So 1 or 2 day rally at the most, probably reclaim about 50% of that big candle, and then away we go. So proceed with caution, right? That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.